Hello everybody, Keppel Reit's full year 22 results are out, and I think that the results were extremely good actually. I thought the results delivered multiple beats on multiple fronts. So let me talk about why I thought so. This is the share price performance for the past 1 year. You can see that the share price really took a beating, right? From 1.25, then boom, 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 dropped to $1, and then boom, 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 and then in November it dropped to 86 cents. It was crazy, man. I was extremely happy actually at this level because I talked about it in the video over here. I bought quite a lot of Keppel Read during this period. In fact, I managed to buy the bottom at 86 cents, which is a surprise to me because normally my timing is horrible, and after I buy something, things will just continue to fall. But this kind of numbers, at this kind of share price, the valuation was extremely cheap. It was trading at the 0.65 price of book, yielding around 7%, 6.8% I think, based on this share price, which was really stupid, right? Because this is a solidly blue chip REIT, pretty well managed, especially over the past few years, with solid assets in the heart of Singapore CBD, in MBFC, ORQ, OFC. These are solid blue chip prime location assets. Certainly, I mean, if you don't want to buy, that's fine. But you certainly don't sell at this kind of levels, right? It was rather silly to be selling at this kind of price levels. I couldn't believe my eyes, so I just went ahead and bought quite a bunch. In fact, look at the valuations, which I talked about in the previous video, at they're highlighted over here. You can see that these are like historical levels already. You certainly want to buy at the historical levels. But you can see for the greater part of the past 2 months, the share price hasn't moved. So even if you have missed the bottom over here, there's still plenty of time for people to go in and slowly accumulate, right? But no, this is the markets. Nobody wants anything until everybody wants everything, which is stupid. You can see the people were very worried about all these worries. Rate hikes will impact the DPU. Then the rate hikes will mean cap rates go up, valuations and fall. So valuations fall, the gearing will go up and then burst 45-50%. Then they will ask for a rights issue and what. And then people worry that work from home means offices will be obsolete. As you can see from the US offices, getting a bit of trouble with the US office REITs. And then tech layoffs mean that the people will just abandon offices. But people don't realize something, right? This is a REIT on Singapore prime office assets. It's not some out of nowhere offices in the US and Australia or whatever. These are prime assets. All these things will not happen, dude. So this is the numbers, and first of all, why I think the REIT beat on the DPU front. So the last year's DPU was 5.8 for the full year, and people were expecting the DPU to fall by 10 to 15%, I think, for this year. Why? Because they look at this analysis, right? Sensitivity to interest rates. So 50 basis points up means 2% down in the DPU. So people say, oh, SORA has moved up by 2.5 to 3%. Therefore, you take this and times times 6. So 2 times 6 is 12. So people say, oh, this one will drop by 10 to 15%. I think that's the anticipation. But despite not dropping, this thing actually went up. So it was a bit on a massive bit, right? Because people were expecting this number to be down like 10 to 15%. But this is up by 2%. So a lot of it was helped by the anniversary distribution of $10 million. But even if you exclude this 10 million, so 210 minus 10 is 210. So 220 minus 10 is 210. So 210 versus 212 is still constant, right? So it didn't drop at much. Even if you exclude the 10 million distribution for the anniversary celebration. And that's because while interest costs have gone up, but their top line has also grown. Why? Because of a rental reversion. So if you look at the last year, second half 22 presentation slides, it's very apparent that the rental reversions will be very positive. So look at the presentation slides. They tell you that the passing rent was 11.3, and then the expiring rent was 982, 1081, and 1072. So if people bothered to open up the presentation slides and do the percentage change, you can see that the upon lease expiry and renewal, there's going to be a massive spike up in the rent. It's a very apparent mathematical formula, right? If you look at the Business Times reporting after the analyst call, Reversions for the last quarter was 23%, full year was 10%, which is in line with everything you see over here, right? So if people bothered to do some calculations, it will be apparent that what was going to happen in the Singapore office dynamics. For 23, the manager's view is that it's going to be a tale of two halves. First half is still going to be quite positive, and then second half, maybe recession fears come in and supply come in, and there'll be a pause in the rent increase. But I think if you look at the recent presentation slide given by the manager, the average signing rent currently is 11.54. So expiring rent is 11.43, 11, and 11.11. So this number is still above all these three, right? So I think there's still going to be maybe a single digit or low teens increment in the coming year. So that will help to offset quite a fair bit of the rate hike impact on the financing cost. So I think it's quite the DPU is still going to be quite respectable, I think. So the second fear that people had was on the cap rate spikes and therefore valuation drop and therefore NAV and a lot of fears. You can see NAV did not drop; it rose from 129 to 134. In fact, if you look at the FX movement, right, Aussie actually depreciated against the Sing. So last year was like 95, and as of December, it was December 31st was 91. So Aussie depreciated against the Sing, and therefore you should expect the valuations to go down, but instead it went up. So that means that the cap rates must have compressed, which is definitely what happened. So this was the cap rates as of December 22, and this was the cap rates as of December 21. You can see actually for Singapore offices, the prime offices actually had the cap rates compressed from 3.5 to 3.4, 345 to 3.3, 363 to 325. So actually for MBFC has really seen a massive compression in the cap rate. I think the demand for all this Singapore stable prime office is still unabating. So ORQ saw a uptick though from 345 to 350, so 5 basis points, and Keppel Bay was flat. So overall, you can see the Singapore offices has actually gone up in valuation, which is not surprising if you followed the Suntec City's recent numbers. So same thing has been happening also. In Australia, things are a bit mixed because cap rates have expanded though. So if you look at the cap rate as of December 22, and that for cap rates of December 21, actually cap rates have gone up 463 to 475, 513 to 528, and so on and so forth. You can see the numbers. A bit of a spike of around 10 to 15, maybe 20 basis points, which is also in line with what you saw in Suntec's numbers. And you can see that in Suntec's numbers, the UK offices actually have their cap rates really spiking up by 25 basis points. So Australia is a bit lower, just like mid-teens kind of 15 basis points kind of move up. But nonetheless, the valuations for the overseas properties are still higher though. You can see the Blue and William property helped with the valuation going from 162 to 211 because the this is under construction, right? So now as the completion nears, the valuation will go up. So overall, the valuations of the properties are still higher. So again, this is confounding people's fear, right, of cap rate spiking and valuations falling and gearing busting and then the rights issue and what not, all those nonsense. It's not gonna happen, dude. This is Singapore. So the capital management is still pretty good. 38% gearing, fixed rate borrowings have gone up from 72 to 76, so on and so forth. I think this stuff is quite interesting. They actually managed to refi the stuff in 23 to 28. So wow, this is January 23 and this chunk is almost all gone already. So you can see this stuff 486 million it's moved out to 2028 to 486. So well pretty agile refinancing, right? So for 23, not much you don't have to worry too much about the refi anymore. But I think the trickle through of rate hikes to the all-in interest rate will still continue though. So this number will still continually go up. But this is helped in some ways by the fixed rate proportion. So 76 is still a decent number. I think increasingly this thing is getting more and more important. The ESG thing. You can see that for green credentials, this is the only REIT with Singapore offices all BCA green mark, right? increasingly this is going to be important because their sustainable financing is going to help to lower the interest cost, and also because of the ESG certification, more funds will be able to buy their units, right? Because nowadays, if you're not ESG certified, then the fund managers cannot buy your units. So this is increasingly important, I think. So, and this is the last part, which is the next 5 years. They still have this magical tool, right? 100 million of distribution over the next 5 years. So 10 million every half a year, which is what you saw just now in the numbers. So again, this is a tool for them to manage the impact on the interest rate hikes. A lot of the concerns over the next few months will be on the looming recession, I think, and also on the impact of the tech layoffs and whether or not you're going to have a offsetting effects from the banks' financials, as well as the small offices. They are really trying to make their way into Singapore post the reopening of China and Hong Kong, right? So, well, I think I'm still quite happy with my accumulation of the REIT in November. So, how about you guys?